Usually when you look at a chart or like a graph representing some kind of data, there is this comforting expectation of order.
Yeah, totally.
Yeah.
It feels almost like engineering, right?
Exactly. You see a trend line moving steadily upward, the math looks solid, and you lean back and think, okay, things are fundamentally good, like the system is working.
Right. It feels binary and safe. Like the line goes up, that signifies health and prosperity. The line goes down, well, that signifies a problem we need to fix.
But then, you step into the world of day trading, specifically dealing with short-term market volatility. And suddenly that beautiful, clean chart is just violently thrown out the window in the blink of an eye.
It really is.
Like the line doesn't just go down, it teleports, it spikes. It just completely breaks the visual logic of the screen.
It is the absolute definition of financial muddy waters. I mean, it's where all your visual assumptions are just instantly weaponized against you.
Yeah. Well, welcome to the Deep Dive, where today we are presenting a special edition, the Franks Report. I am your host, Jessica.
And I am Philip.
Before we jump into today's breakdown, just a quick reminder to, hit that follow button wherever you are listening so you never miss our future content.
I definitely do that.
And also, if you want to take the concepts we cover today much, much further, you really need to grab a copy of our book, The Funded Micro, Modern Futures Strategies for the Prop Firm Era.
It's a game changer, honestly.
It is, and just to clarify that term for absolute beginners, a prop firm or proprietary trading firm is essentially a company that allows you to trade their capital instead of risking your own savings, provided you can prove your profitability first, of course.
Yeah, exactly.
You literally cannot miss the book. It has this gorgeous, really striking spiral staircase on the cover.
That cover really is striking, but I mean, the strategies inside regarding risk management are what will fundamentally change how you interact with the screen.
For sure. And speaking of interacting with the screen, we have to thank our incredible sponsor, TradingView. They provide the absolute fastest way to follow markets.
They really do.
Seriously, if you are charting your trades, you need to be using them. You can use the referral code down in the description right now to save $15 on the business standard plan.
Yeah, having the right technical infrastructure is, well, it's half the battle when you are dealing with the kind of volatility we're about to discuss today.
So true. So let's unpack the mission for today. We are taking a step back to explain market mechanics simply. We're specifically looking at how things operate for a complete beginner.
A ground-up approach.
Right. And to do this, we've gathered this massive stack of sources. I mean, institutional trading playbooks, macroeconomic research papers, decades of historical market data.
It's a lot of material.
It's huge. But we're going to distill all of this to look at fundamental economic data reports. Think of these reports as the market's weather. They are the primary catalyst driving short-term price volatility.
That's a great way to look at it.
We basically need to figure out how to read this weather radar so you don't accidentally sail your account into a Category 5 hurricane.
Framing it as weather is incredibly accurate because, when you're first starting out, the market feels completely random, like a slot machine.
Oh, 100%. It feels rigged.
Right. But it does not move randomly. It reacts to raw data. Institutional participants, like the massive banks, the hedge funds moving billions of dollars, they do not trade based on a hunch.
No, they definitely don't.
They use this raw data to constantly adjust their valuation models. And, most importantly, they use it to adjust their expectations for future interest rates.
Okay, so while there are dozens of different reports crossing the news wires every single week, things like manufacturing outputs or housing start,
it's endless.
It is.
Yeah.
But our sources make it overwhelmingly clear that there are two massive reports that act as the ultimate engine of volatility for the global markets.
Oh,
the first one is non-farm payrolls, which is widely known as NFP.
Yes. If you are trading active markets, NFP is a day you have marked in bright red ink on your calendar.
Always.
It is released by the Bureau of Labor Statistics on the first Friday of every month at 8:30 in the morning, Eastern Time.
Okay.
And it's basically a statistical representation of the total number of paid workers in the United States. But, as the name explicitly states, it excludes a few specific groups from the calculation.
Yeah, let's look at those exclusions, actually, because NFP leaves out farm workers, employees of the federal government, private household employees, and nonprofit organizations.
Right.
Now, I understand leaving out farm workers because agriculture is highly seasonal. It depends on weather rather than economic health. But why ignore the federal government or nonprofits?
That's a common question. It's because the goal of this specific report is to measure the pulse of the commercial, profit-driven economy.
Okay.
Yeah, government hiring is driven by budgets and legislation, right?
Right.
Not necessarily market demand. And nonprofits operate on a completely different set of financial mechanics entirely.
That makes sense.
So by stripping those out, the Bureau of Labor Statistics is trying to give institutional investors a pure look at how confident everyday for-profit businesses are.
Basically asking, are they expanding and hiring, or are they contracting and firing?
Exactly, because consumer spending makes up roughly 70% of the U.S. gross domestic product. Therefore, the employment status of the population directly dictates where the entire economy is heading.
Okay, so the headline number everyone stares at is the net change in jobs from the previous month. Let's say the consensus expects we added 200,000 jobs, but the report drops and it shows we added 300,000.
A huge beat.
A massive jobs boom. Now hold on, because I want to challenge the basic logic here for a second. You hear booming jobs and you naturally think, okay, the economy is thriving.
Right, line goes up, everything is good.
Exactly. But our institutional sources explicitly warn that a red-hot jobs report can actually spook the markets and cause stocks to crash.
It happens all the time.
How does the cost of borrowing money outweigh the fact that businesses are clearly making enough money to hire hundreds of thousands of new people?
Yeah, that is probably the most common cognitive trap for a new trader. You really have to remember that the stock market is a forward-looking mechanism.
Okay.
The current success of those businesses, the fact that they're hiring right now, that is already priced into their stock values. What the market is terrified of is what a booming labor market forces the Federal Reserve to do.
Because the Federal Reserve is mandated to control inflation.
Correct. A booming labor market means companies are competing for workers. And to attract those workers, what do they have to do? They have to raise wages.
Right.
If people are making more money, they are willing to pay more for goods and services, which drives up prices across the board. This is inflation.
Okay, I'm with you.
So to cool that down, the Federal Reserve steps in and raises the federal funds rate. This makes borrowing money incredibly expensive. So if a company wants to take out a loan to build a new factory, the cost of that loan suddenly eats into their future profit margins.
Which means the stock is mathematically worth less in the future.
Exactly. I mean, analysts use discount cash flow models to value companies. And when the cost of capital goes up, the present value of future earnings goes down.
That's fascinating.
And furthermore, if you are an investor and the government is suddenly offering a 5% guaranteed yield on a risk-free treasury bond because interest rates are high, why would you risk your capital in a volatile tech stock?
You wouldn't. You'd pull your money out of stocks and put it right into bonds.
Exactly. So a massive jobs beat is incredibly bullish for the US dollar, but it acts like an absolute wrecking ball for equities.
Okay, wow, that clarifies the mechanism beautifully. Good news for Main Street becomes toxic news for Wall Street, all because of the looming threat of the Federal Reserve.
Yep, that's the irony of it.
But the headline jobs number is just one piece of the puzzle, right? The sources point to a secondary metric inside the NFP report that sometimes hijacks the entire market reaction. Average hourly earnings.
Oh yeah. Average hourly earnings is the literal canary in the coal mine for persistent inflation. If you want to know if prices are going to be higher 6 months from now, you have to look at what workers are being paid today.
Because if the jobs report shows a massive beat, like that 300,000 jobs added scenario, but the average hourly earnings metric shows that wage growth actually shrank, the market reaction completely changes.
It changes because the inflationary pressure isn't there.
Right.
If businesses are hiring a lot of people, but they are doing it by offering lower-paying part-time jobs, the overall disposable income of the consumer base isn't actually rising.
Okay.
The Federal Reserve looks at that and thinks, okay, the economy is growing, but we don't have a wage price spiral happening, so we don't need to hike interest rates.
Right.
In that specific scenario, you might actually see the stock market rally on a strong jobs report.
That nuance is just wild.
Yeah.
There is one more crucial data point inside the NFP report, and that is the unemployment rate itself.
Right.
Now, the sources note that this is technically a lagging indicator, meaning it only changes after the broader economic damage has already been done. If it's old news mathematically, why does it carry such immense psychological weight in the market?
Because the market is ultimately driven by human emotion. And the unemployment rate is the single most visceral metric for the general public.
That makes sense.
When that percentage suddenly spikes from, say, 3.5 to 4.2%, it dominates the evening news. it creates this pervasive narrative of fear. Every day, people start worrying about their own jobs, so they stop spending money.
It basically becomes a self-fulfilling prophecy of a recession.
Precisely. And institutional investors know this. The moment the unemployment rate triggers that psychological threshold of panic, investors will aggressively dump risky assets and rush to buy safe haven assets.
Like what?
They buy gold, they buy the Swiss franc, and they buy U.S. treasuries, purely to protect their capital from the ensuing storm.
Okay, so we have established that wages rising means people have more money, which means they buy more things, which forces businesses to raise prices.
Right.
If we want to see how the Federal Reserve actually tracks those rising prices at the cash register, we have to look at the second massive report in our research, the Consumer Price Index, or CPI.
Yeah, if NFP is the engine of the economy, the CPI is the ultimate temperature gauge. It basically measures the average change over time in the prices paid by urban consumers for a representative basket of goods and services.
You know, I always found that term basket kind of fascinating.
It's a funny visual.
Right. But the Bureau of Labor Statistics actually tracks about 80,000 individual items. They're literally calling grocery stores, checking the price of a gallon of milk, looking at rental agreements, checking the cost of a doctor's visit.
It's a massive undertaking.
Yeah. They aggregate all of this to figure out exactly how much the cost of living is bleeding the average person.
And this specific index is what the Federal Reserve uses as their primary scorecard. They have a stated mandate to manage the purchasing power of the dollar, and they are actively aiming for a target inflation rate of 2%.
2%, right.
So when CPI data is released, it is basically a public report card on whether the Fed is failing or succeeding.
This actually brings up a massive point of confusion in the source material that we really need to untangle. There is the headline CPI, which includes absolutely everything in that giant basket.
Right.
But professional traders and the Federal Reserve seem to obsess over something called core CPI, which actively strips out the cost of food and energy.
They do, yeah.
I have to play devil's advocate here. Why on earth would economists ignore food and gas? Like, if gas goes to $5 a gallon, that totally destroys my personal budget for buying anything else.
Oh, absolutely.
So how is ignoring the most painful parts of inflation helpful to anyone?
Look, I know it sounds incredibly tone-deaf to the consumer, but from a macroeconomic perspective, it is actually a necessity.
Okay, walk me through that.
The Federal Reserve's only real weapon to fight inflation is raising or lowering interest rates. Interest rates alter consumer demand, but food and energy prices are overwhelmingly driven by supply shocks, not demand.
Oh, I see. Are we talking about things like geopolitical conflicts messing with oil supply, or, I don't know, a bad winter destroying crops?
Both. If a conflict breaks out in an oil-producing nation, gasoline prices will spike overnight globally. If a severe freeze in Florida wipes out the orange crop, well, the price of juice skyrockets.
Right.
If the Federal Reserve were to hike interest rates to 30% tomorrow, it wouldn't magically end the war or unfreeze a crop. The Fed cannot print more oil or grow more food.
So they ignore it because their tools can't fix it anyway.
They ignore it because it is noisy. Core CPI, which focuses on things like housing, medical care, and used cars, gives them a much clearer picture of sticky underlying inflation. If headline CPI drops simply because oil prices fell this month, but core CPI remains stubbornly high because rents are still climbing across the country, the Fed knows the underlying economic disease is still present.
Okay, that makes perfect sense. So, when you look at the actual CPI data release, it is broken down into two time frames, month over month, or MOM, and year over year, or YO.
Yes.
Explain how the market parses the difference between the two, because the interplay there seems to dictate these massive market rallies.
Okay, so month over month is your immediate velocity. It asks, what is the inflation momentum doing right now compared to just 30 days ago? Year over year provides the broader 12-month context.
Okay.
The reason you see massive market rallies is due to something called a divergence.
How so? Like, what does that look like?
Let's say the year-over-year inflation is still looking terrible at 6%. The media is panicking, but the institutional algorithms look at the month-over-month data and see it just drop to 0.1%.
Oh, wow.
This creates a divergence. It signals to the market that the momentum of inflation has completely died, and the year-over-year number will eventually start falling due to the base effect of the math catching up.
So it basically signals that inflation has finally peaked.
Exactly.
And the second Wall Street sniffs a peak, they assume the Fed is going to stop hiking rates, which means the cost of borrowing will drop, which sends the stock market into an absolute frenzy of buying.
That is the core secret to understanding this data. You are never actually trading the raw number itself. You are trading the market's expectation of how the central bank will react to that number 3 months from now.
Okay, we need to transition into the actual physics of what happens in the market the microsecond these NFP or CPI reports are released, because it is violent.
Oh, it's absolute chaos.
Right. And our sources point out a phrase that you hear all the time in financial media. It was already priced in. Let's break down the mechanics of what priced in actually means. How does the market expect a number before it's even released?
It starts with the consensus. Major financial news organizations like Bloomberg or Reuters will survey dozens of top economists at various banks. They ask each of them what they think the CPI number will be.
Okay.
They take all those estimates and find the median average. Let's say the consensus is 0.2%.
And the big institutions don't just write that number down. I mean, they deploy capital based on it.
Billions of dollars.
Right.
If they believe the number will be 0.2%, they buy and sell assets days in advance to position themselves optimally for that specific reality.
Wow.
The market reaches an equilibrium based on that assumption. So if Friday morning rolls around, the data drops, and it is exactly 0.2%, nothing happens.
Because they were right.
The market barely twitches. The reality matched the expectation.
But the chaos happens when there is a deviation. If the report comes out at 0.5%, all those billions of dollars are suddenly positioned incorrectly. This triggers what our sources call the deviation spike. High-frequency algorithms, which are parsing the text of the data feed in microseconds, execute thousands of orders instantly to reprice the market based on this new reality.
Yes.
But I have a serious question about these algorithms. You were telling me Wall Street spends hundreds of millions on supercomputers, yet retail traders constantly watch the market violently spike up on a good headline number and then violently crash 3 seconds later.
Yeah, the whipsaw.
Right. If these algos are so advanced, why do they get caught in these massive whipsaws? Shouldn't they be smart enough to read the whole report before firing off orders?
It is a phenomenal question. The issue isn't intelligence. The issue is the physical race for speed.
Yeah.
The first algorithm to execute an order gets the best price. So many algorithms are programmed to only look for one specific variable, the headline number. The microsecond they see the number is higher than the consensus, they fire off massive buy orders. That causes the initial vertical spike.
They shoot first and ask questions later.
Exactly.
Yeah.
But milliseconds later, the slightly slower, more complex algorithms finish reading the rest of the report. And this is where they uncover the first major culprit of the whipsaw. Revisions.
Like revisions to the previous month's data?
Yes. Every single employment or inflation report doesn't just give you the current month's data. It retroactively revises the previous month's data because the government has collected more accurate information over the last 30 days.
Oh, wow.
So the fast algorithms buy the spike because the current month beat the estimate by 50,000 jobs. But the slower algorithms realize that the previous month was just revised downward by 80,000 jobs.
So the actual net reality is that the economy has 30,000 fewer jobs than we originally thought?
Exactly. The complex algorithms immediately begin aggressively shorting the market, selling heavily into the initial spike caused by the fast algorithms.
That's insane.
The market hits a wall, reverses instantly, and creates a violent whipsaw that completely traps retail traders who tried to chase that initial green candle.
It is literally a technological war zone playing out in fractions of a second. Which brings us perfectly to the practical survival guide portion of this deep dive.
Yeah, let's get into that.
If these high-frequency algorithms are fighting it out and creating these massive whipsaws, how is a beginner supposed to survive? Because one of the most mechanically dangerous things that happens during these releases is the behavior of the spread.
The spread is simply the gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Under normal conditions, in a highly liquid market like the S&P 500 futures, that gap is microscopic.
Right, but during CPI or NFP, the spread rips wide open. I want to use an analogy here to explain the mechanics of this. Imagine you show up to a massive, bustling auction house to sell a valuable painting.
Okay.
The room is packed with people screaming out bids, the spread is tight, but the second you step up to the podium, a fire alarm goes off. Every single wealthy bidder quietly sneaks out the back door to avoid the danger.
Right.
Now, you are forced to accept a terrible, low-ball price from the one random guy left hiding in the back row.
That is exactly what happens to the liquidity providers.
Sure.
The massive banks that usually stand ready to take the other side of your trades are well aware that an unpredictable algorithmic hurricane is about to hit.
They don't want to be there.
They do not want to get run over. So seconds before the data drops, they systematically pull all their limit orders off the central order book.
The bidders sneak out the back door.
The market instantly loses its depth. If you try to execute a market order during that exact second, there is no one there to match your price. Your order aggressively slides down the order book looking for anyone willing to take it.
And that's slippage.
Yes, you experience massive slippage. You click buy at one price, but you get filled at a wildly different, terrible price, instantly putting your account deep in the red before the trade has even really begun.
Our sources are blunt about this. Trading through these releases without a massive institutional advantage is reckless gambling. So practically, what is the protocol for a retail trader to actually protect themselves?
The professional standard is implementing an observation period. You institute a strict, unbreakable rule to stay completely flat, meaning you have no open positions for 15 to 30 minutes following a major data release.
You literally sit on your hands and watch the chaos happen without participating.
You sit on your hands. You let the fast algorithms fight the slow algorithms. You let the revisions get digested. You let the liquidity providers slowly step back into the room and tighten the spread.
Makes sense.
Usually after about 30 minutes, all the fake outs designed to trigger retail stop-loss orders are finished. The big money finally reveals its true directional bias, and the sustainable, real trend for the day begins.
But to know when to sit on your hands, you have to know when the fire alarms are scheduled to go off.
Yes, absolutely. You must check a macroeconomic calendar every single morning before you even open your charting software. They are freely available online. They color code events based on expected volatility.
Okay.
NFP and CPI are universally coded as high-impact red flag events. When you see that red flag at 8:30, you know to adjust your risk parameters.
The sources highlight one final brilliant thing for beginners to watch during this observation period, and that is correlation shifts. Explain how the mechanics of different asset classes decouple during a massive data drop.
Normally, markets move in a somewhat correlated logical dance, but an extreme inflation print acts like a bomb going off, and different asset classes will scramble to find their new baseline.
Right.
For instance, if CPI comes in shockingly hot, you will see the US dollar and Treasury yields violently rocket upward.
Because the market is pricing in the Fed hiking interest rates to fight that inflation.
Correct. And simultaneously, because the risk-free rate of return just shot up, you will see gold and the S&P 500 crash as money flees risky assets and non-yielding assets. If you are just staring at one chart, it looks like pure random chaos.
Yeah.
But if you are watching the broader correlations, you are actually watching the physics of capital flowing across the global economy in real time.
Wow.
Once you see the dollar and yield screaming higher together, you know exactly what the new underlying reality is, and you could eventually trade the stock market in alignment with that reality once the dust settles.
So what does this all mean for you listening right now? The biggest takeaway we found in all this research is that your goal is not to become a macroeconomic savant with a PhD. Your goal is to become an operationally aware trader.
Exactly. You do not need to predict the exact data point. You simply need to respect the mechanical damage it can do to your account.
By understanding the underlying physics of non-farm payrolls and the consumer price index, you transition from being a victim of inexplicable volatility to an educated observer who understands the engine of the market.
You learn to look at the radar and wait out the storm, instead of just standing in the rain complaining that you got wet.
Yeah. And I want to leave you with a final provocative thought to mull over. We talk about these reports as abstract, high-level institutional concepts, but consider your own mundane daily life for a second.
All connected.
It really is. Think about the time you asked your boss for a raise because your rent went up, or the time you stood in the grocery aisle and actively decided not to buy a carton of eggs because they were $1 more expensive than last month.
Yeah.
Those small, frustrating, deeply personal choices, they are the exact literal data points being scooped up by the Bureau of Labor Statistics. Your daily friction is what populates the CPI and NFP reports.
It's wild to think about.
You are the data that ultimately triggers the high-frequency algorithms moving trillions of dollars. The entire global financial system is just a massive high-speed mirror reflecting your own daily struggle at the cash register.
It is a profoundly sobering realization when you connect those dots.
It really changes how you look at the economy. Well, thank you for joining us on this deep dive. Remember to visit www.franksreport.com to grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era.
And please, hit that follow button wherever you choose to listen so you don't miss our next breakdown.
Until next time, stay aware, check the calendar, and we will see you on the next deep dive.